For those just getting started with investing and learning about their finances at a deeper level, there's several items that we need to talk about relating to the types of financial accounts that are going to be most beneficial for them to start with. Today we'll talk about 5 investment or financial accounts that are beneficial to every individual and every family that they should have in their portfolio. What is the first financial account that you should have in your portfolio? The number one account that you should have in your portfolio is a checking account. Obviously, this one is very common, very well known. Everyone basically has a checking account as soon as they're a teenager, maybe once they get their first job. This one is very well known. A checking account is just money that you're putting your dollars into, and the bank is holding them there and insuring them through the federal government up to $250,000. A lot of people prefer to put their money into a checking account as compared to, say, under their mattress, because a checking account is going to provide them with that insurance from the government that is offered with checking accounts. Now, if you have a checking account, you know there is no interest rate on checking accounts, and if you have an interest rate on your checking account, you are very blessed. But even if you do have a rate on your checking account, it's probably going to be a very low interest rate. These accounts are not for growing your money sky high, out of the roof. These accounts are just for holding your money that you know, I have to make purchases out of this account. I have to pay for my living expenses. Like, I know this money needs to come out of my checking account. The biggest mistake that I see families and people making with their finances is treating their checking account like some sort of savings or investing account and just stockpiling money in that checking account. Your checking account is not for your savings. It is not for your money to be stockpiled in. You want your checking account to be as low as possible, but still enough to cover those monthly expenses so that you know you're not going to be overdraft. The second account that we're going to be talking about is a savings account. Once again, very prevalent. A lot of people have them if they have a checking account. But here's the deal. Savings accounts nowadays don't make that much money. A lot of banks do not pay that high of interest on your savings account. You might be getting a couple of cents per month. A lot of people make the mistake of putting a ton of their savings into a savings account. But in reality, it is not making you any money. It is not making you any money. And this is really sad, because when you have a savings account and you're trying to grow your money and save for a specific goal, you don't just want to feel like you're not getting anywhere. A lot of people view it as, oh, I've moved money from my checking to my savings. Yay, I put $100 into my savings. I've added $100 and every month I'm going to do that. But the thing is, you could be growing it so much more exponentially. I would suggest for most people to put their money from a savings account into a high yield savings account. Now, these are very similar, and back 20, 30, 40, 50 years ago, it was theoretically the same thing because interest rates were higher back then. Savings accounts were paying much higher interest rates. Nowadays, you have to actually take the initiative to get a high yield savings account. A high yield savings account is going to give you a much better interest rate for the money that you have in there, so you're going to be able to exponentially save more. Is this going to make you a millionaire? Absolutely not. It is not going to make you a millionaire, and it is not going to make you rich overnight, but what it will do is it will continue to grow your savings account at a much faster rate than any other account of the same type, than any other account that's of a similar risk level as a savings account. For those who don't know, I'm Aliana Keller, And if you like this content about finance, I talk about faith, finances, and wifehood on this YouTube channel, so be sure to go ahead and subscribe if that's something that you're interested in and if you find my content valuable. Thanks. So as we said, a savings account is not a long-term goal that you're trying to reach, but it is going to help you reach your short-term goals just a little bit faster or with a little bit more money in the bank for those. High-yield savings account can help you literally save hundreds of extra dollars each month, especially if you have a really high savings. For people like me, families like me and my husband, or young career individuals, or just young singles, anyone probably before the age of 30 is most likely going to be saving up for a house or a car or something within the next 3 to 7 years, right? As we're saving up for those goals, putting our money into a high-yield savings account will help us to reach those goals so much faster than just letting them sit in an ordinary bank savings account. For instance, my husband and I recently, in this past month's statement, made $106 just from the interest that our savings produced for that month, which is amazing. For us, $100 is a lot. Now, for everyone, that may not be the case. But the more money that you have in that high yield savings, the more you're going to help. So it's a quick, easy form of passive income that a lot of people don't think about, but can be very beneficial and completely change the trajectory of your long-term financial plan. For us, we are saving for a house and eventually a new car and several other smaller purchases, along with our emergency fund money. And we put that all into a high yield savings account. We actually have an account at Ally Bank, and it's an online account, but it's so cool because they allow you to put your different money into separate buckets. So within the account, you can select emergency fund or house fund or car fund, and you can actually put money into each of those different funds, and it shows you visually that for you right away. So if you don't have a high yield savings account, Ally Bank is a great way to go because it does allow you to kind of have fun with saving for those buckets. Like if you have a vacation fund, you can be like, okay, create the vacation one. Now, I'm a super data loving person, so maybe that's just why I geek out over that, but I think it's so amazing that you get to see the breakdown of what you're saving for, and it really gives that extra momentum for you wanting to save. At least for me it does. I would suggest putting your money into a high yield savings account, or at least looking into them at a deeper level, because they can truly help you save a lot more money. This is liquid money, and when I say liquid, I mean cash, or theoretically cash. A liquid investment or a liquid money would be something that within the next couple of days you could get the value of. In investing, you're putting your money into certain stocks or bonds or various other investments, and you can't always redeem them or sell them or get the money at that specific time because of some, depending on what type of investment you have, there may be rules or constructs around that. But with a high yield savings account, it is just like an ordinary savings account where you can pull your money out if you need to, whenever you want. You just won't make as much interest on it. So it's a very great option for people who need a little bit of extra passive income to accelerate their savings, but they don't want to fully go into the stock market or other investments because they don't have that long-term capability right now. The third type of account that we are going to be talking about is an employer-sponsored retirement plan. These are your 401ks, 403bs, TSPs. They have a lot
of different names, but the overall goal of them is that they are sponsored by your employer. You can contribute, your employer can contribute in some cases, and some employers will actually contribute to your plan even if you don't. But overall, this plan is just a retirement plan committed for retirement funds, but one that is sponsored by your employer.
You will hear from a lot of people and they'll say, an employer sponsored plan is just free money, so automatically invest your money into that. Or the free money that your employer gives is awesome, it's so great. If you are enjoying this content, please be sure to give this video a thumbs up. I would so truly appreciate it. It'll just help get this content out to more people so that way they can get the same information that you're getting. Guys, it is not free money. Now, it is free money in the sense that yes, if you don't put that money into it, that contribution, your employer's not going to also contribute. But you are working for it. Like, it is not free money. It is part of your job and your career to work for your employer. This is just a benefit that you're getting because you're working for them. It is not free money. You've worked for it and you're working hard for it at your job. Now, if you're a homemaker like me or like many other women, or a stay-at-home mom or a stay-at-home wife, you really don't have the option of having an employer-sponsored plan. But that doesn't mean that you still can't prioritize putting money into your husband's employer-sponsored plan that he has through his work. Even though you may think that this section or portion of the video doesn't apply to you, it can be good information to know even if you are a homemaker. That way you can go right ahead and relay this information to your husband and find ways in your financial plan that you can prioritize putting money into his employer-sponsored plan and see how that's going to play out for you guys and your financial goals. With an employer-sponsored plan, the really cool thing is that you've worked hard for it, you put money into it, and then they generally will match that money. Now, a lot of times there is a vesting schedule. What is a vesting schedule? A lot of people don't necessarily understand this right away, but a vesting schedule is theoretically how much money that the employer is putting in will stay in the account even if you don't move jobs or find another career, or if you stop working for that company. So for many employers, they'll have a vesting schedule. And so they'll contribute to your plan, but if you leave that employer during the time that they're contributing and you aren't fully vested, you'll only get a piece of their contribution. However, this does not mean that you don't get the money that you've contributed. Once you've contributed your money, that's in the plan. The thing you're primarily worried about in this case is, does the employer give all of their money to the plan? Now, for some cases, some employers will give 100% vested right away. I currently work as a virtual assistant and we are 100% vested immediately, which means that if I were to leave the company tomorrow, my contribution and my employer's contribution would stay with me. I would still have that under my retirement plan in my 401k, which is really cool because it allows people to make decisions based on their career without having to kind of worry about, have I finished this vesting schedule for this employer? And I do think that's something that employers would be wise to start implementing, is 100% vesting right away, because then they know that the talent that they're retaining is because they're actually retaining it and not just that their talent is just staying there for the benefits, which is a whole nother conversation for a whole nother time. But point being, if you have a vesting schedule, you'll see on it, 3 years till you're vested, or 5 years till you're fully vested. But sometimes you have to work for the company for that specified period of time because the company wants to retain their talent and employees. in order to give them that hiring benefit or that workplace benefit. If you work for that specified amount of time, after that you are 100% vested and you have all of the money that they've contributed, you continue to have, and you're not really having to worry about this question of, am I vested? Am I not? So what's cool about this plan that not a lot of people necessarily understand is that when you have a retirement plan, like one of these employer-sponsored plans, it is automatically going to invest the money that you're putting in. It's investing them in mutual funds. Mutual funds are a collection of stocks, individual stocks. And if you don't know what stocks are a piece of a company. I may do a YouTube video actually going deeper into stocks and bonds and mutual funds, what's the difference, all the types of investments. But for today, just understand a mutual fund is a lot of little pieces of a company that you're investing in. And so when you have an employer-sponsored plan, boom, automatically you're invested in some sort of mutual funds. But you're invested. A lot of people I don't think realize that they probably already have investments. They just don't know that they have investments. The fourth type of account that we're going to be talking about is a Roth IRA. A Roth IRA is a way that individuals can save money for their retirement and still have the same tax benefits that an employer-sponsored plan would have. With a Roth IRA specifically, you are taxed on the money that is put in there before you put the money in there. So you do not get a special deduction for putting money into a Roth IRA. However, when that account grows and continues to grow every single year, you get all of the money at the end when you're 59 and a half or greater and you are taking that money out. Every single dollar that you both put in there and that have grown is your money. You do not have to pay tax on it at that point, which is huge. When you're growing money and investing over the long term, you have that long-term goal in mind that says, I'm gonna be growing this money for a specified period of time, generally till retirement. And by having that long-term mindset, you are able to grow your money that much more. Investments do better when they are long-term. And so this is amazing because every single year of growth is not taxed on when you have a Roth IRA. A Roth IRA can be so beneficial. You can only put a certain number of dollars in every single year, and there is an income max out phase. So if you have above a certain income level, you actually can't contribute to a Roth IRA. However, there is a legal way around this, kind of around it, but it is completely legal. A way that you can get around this is by putting your money into a regular IRA, which does not have those phase out requirements, and then each year you can actually do a Roth conversion, converting that amount of money into a Roth IRA, and that allows you to put it into that after-tax money. Now, the year that you convert, you are going to be taxed on that money that year. So if you're implementing this strategy, you want to be sure that you're doing it in a tax-effective way. Definitely talk to your CPA or accountant upon how that can work for you. But for the majority of people making normal wages, we aren't on that max out phase. We're just contributing to our Roth IRAs as normal people would. How much you contribute to your Roth IRA is going to depend upon you and your family and your financial situation. But if you are in a little bit of a higher net worth family and you have more money to commit to that Roth IRA, then I would actually suggest for both the husband and the wife to have their own Roth IRA. Unfortunately, they don't do joint Roth IRAs because, why would the government want to incentivize marriage? Sometimes you do wonder though, is it a conspiracy? I don't know. Drop a comment. Do you think that that's intentional, that the government doesn't want us to join our accounts? Finances are a big topic in marriage, so you never know. Anyway, point being, because you can each only have an account, I would suggest for both husband and wife to have an account. For most families, once again, this is up to your individual discretion, But for two people to have that Roth IRA, it can really help to maximize the amount of money put towards saving for that family's retirement fund, if that's the method that you want to go. Roth IRAs are definitely a really cool aspect. They have a lot of cool functions. You can invest in assets just like them, but however, most Roth IRAs, you actually get to choose and select your own investments rather than just going with the mutual funds that your employer-sponsored plan requires you to go with. So you can become a little bit more creative here, but it should be remembered that this is your retirement funds. You don't necessarily want to play around with them a ton, especially as you get older. You want to be in a little bit more secure assets. I might make a video on this coming up later, so be on the lookout for that. But that goes along with investing in your investing strategy, along with understanding the different types of investments that there are out there. The fifth type of account that everyone needs is a brokerage account. Now, does every single person necessarily always need a brokerage account? Maybe not necessarily, but someone's beeping, sorry. I don't know if you guys heard that. But having a brokerage account can be very beneficial to growing your finances if you've already saved that money for retirement. You've kind of maxed out your employer-sponsored plan and your Roth IRA. In addition, if you just have more funds that need to be used more quickly than retirement, but you still want to get into investing, a brokerage account would really help with that. In general, investing should be a long-term goal, not just a short-term. In the short term, the statistics show that investing turns into more like gambling the shorter the amount of time that you are putting your money in. However, the longer amount of time, the more statistics that show that it is a progression upwards, that there is a science to it. So definitely research that more, get that into perspective about investing. But a brokerage account can be very beneficial. You can have a joint brokerage account, which is awesome, with your husband and wives. So you can go ahead, create a joint brokerage account for your family and invest money there if you need to. This is primarily to help you with some of those long-term goals that aren't so long-term that it's retirement, but maybe they're not within the next, 5 to 7 years or 3 to 5 years, depending on what financial planner you're listening to. I hope this video was super beneficial to you guys, helping you understand the different types of accounts that you can create for your family today, so that way you can continue growing in financial stability and peace and understanding with your finances. Check out these next couple videos that I have about finances, and go ahead and subscribe for more content like this. Thanks, guys.